Hey, how you doing? Seth.struiksma here from Woods Real Estate Services, and I'll let Alisha introduce herself.
My name is Alisha Sirois, and I'm with Realtor Mortgage Company. Welcome.
And thanks for joining us. So we're going to be talking about how to buy a house here in San Diego, and we'll guide you through the process. Great. So first and foremost, my name is Seth again. I'm with Woods Real Estate Services in Mission Hills. I specialize in pretty much all of Metro San Diego. I've been a realtor since 2008. My background is really in flipping houses for about 5 years, and then moved into sales around 2015 or so. So love what I do, and I'll let Alisha introduce herself.
Hi, my name is Alisha Sirois, and I'm with Guild Mortgage Company. I've been with Guild Mortgage Company for 17 years and doing mortgage loans in San Diego County for over 20 years. Really, I just like working with buyers to help them get approved for the very best finance programs available for them, and helping them understand the process of buying a house and getting a loan and what they need to know.
Alright, so a brief overview of what we're going to be covering today is we're going to go with some local trends in San Diego, the home buying process, how to finance your home, and then we'll do a nice little recap. So in San Diego, there's been a lot of new construction. If you guys are familiar with Mission Valley, there's a huge project going there. It's called Savita. There's a lot of new construction going down there. There's a lot of new construction going on in downtown. So some things to really think about with new construction or even planned developments is you're going to be dealing with community fees, you're going to be dealing with HOA fees, and the buying process is a little different. You're going to be dealing with a sales center, and you can have representation or not have representation. Again, there's benefits of new construction. It's brand new, it's beautiful, and it's your home, the first one to live in it. So that's a benefit. Everyone's asking for a deal. Everyone's usually asking for a fixer-upper. So there are still fixer-uppers still out there. They're a little bit more difficult to find. But some things to be aware of with buying a fixer-upper is if it's lendable. Some properties may need some work, and I know some people love HGTV the house, but sometimes the house is actually not lendable, and so we have to take notice to that. I'll let Alisha kind of cover that.
Yeah.
What would not be lendable.
One of the things that Guild Mortgages does for properties that aren't lendable is we actually do have a renovation loan department, and the renovation loan department can help buyers who want to get into a home that's not financeable. Basically, for a home to be financeable, we're looking for minimum housing standards, health and safety standards. You know, it can't have a leaky roof, it can't have broken windows, or worn water pipes and those kinds of things. If it's just cosmetic stuff like paint and ugly carpeting or anything like that, then those are typically financeable. It's when you get into the true inhabitable conditions that it wouldn't be financeable.
Yeah, and depends on what loan you're also going for. I know when I bought my first house, I used an FHA loan, which we'll cover, but it needed some minor things. It needs to have flooring, can't have broken windows. Depends on which loan you have too. So another big trend right now, ADUs, accessory dwelling units. These are basically granny flats. A lot of people have been asking about this. So the state of California actually passed an ordinance a little while ago, but San Diego now has really helped ramp that whole thing up. And so a lot of people have been asking about, can I put an ADU on my property? Can I put an ADU? And so ADUs are great. They don't really have to follow the guidelines of what normal building restrictions have to follow when you're building new construction. It also adds a lot of value to your property. Suddenly your house can now become a duplex, 2 units. So it's a great thing that's going on right now. That leads us to the large lots. So there's a lot of large lots in like North Park and Logan Heights, Golden Hill, all around San Diego. And this has been a really big hot topic for first-time buyers because they can now think about adding an accessory dwelling unit onto their large lot. And it really opens up the idea of what can happen to your property. Trend number 3, so I added this in and it's becoming a really hot topic, Airbnb or short-term vacation rentals. A lot of people have been asking me about, can I Airbnb my place, or hey, I want to buy an investment property and Airbnb it. It's a really hot topic right now. It's kind of uncertain with what San Diego is going to do. Other cities in San Diego County actually restrict Airbnb, so it's kind of a risky investment, but right now, San Diego doesn't have any real regulations on Airbnb. It depends, on the condo complex. So if you do buy a condo, you'll have to discuss that with your realtor if it's allowed. A lot of condo complexes do not allow short-term vacation rentals. But on an investment side, the lending side of things, I will let Alisha talk about that.
Yeah, absolutely. And so when you're buying a house from a lender, we don't really know when you're buying it for investment and buying it for a standard long-term rental or an Airbnb. So what we do when you purchase an investment property is the appraiser will actually determine the fair market rent for the property as a traditional investment property and then qualify based upon that. Certainly it's an option and it's an opportunity that can be available for home buyers.
Yeah, exactly. And condos are one type of property, but when you buy a house, usually there's no restrictions on what you can do with your house. So
Right.
I have an Airbnb myself, and it's great. It's an extra source of income. It's just a great option for when you buy a property. All right, we're going to jump into the actual home buying process, the most exciting part. All right, so before you buy something, you need to consider a couple things. This is a really important thing. You need to consider renting versus owning, how long you're going to be living there, life changes, and personal finances. So you really need to think about if you're going to be living in this property as your primary residence, how long you're going to be there. And you really need to think about that. You might be having babies soon, or you're going to be having in-laws move in with you. You need to really project out and think in the future how your life is going to be. And then obviously, you need to think about your personal finances. You're buying a house, you're going to need to think about down payment, renovations, taxes, all those fun things. So Alisha is going to talk about the differences between renting versus owning.
Absolutely. So one of the things you benefit for when you're owning a property that you don't really see you don't see any of when you're renting a property is the appreciation. And what the appreciation of the property is price that you pay for the property when you purchase it. Years down the line when you go to sell it, you could see appreciation in that you might be able to sell the house for more than what you've paid for it. So it's like a guaranteed savings account. Also, as you're making your mortgage payments, the amount that you owe on your house goes down. So that just lends more money into the profitability when you go to sell your house. That's where the appreciation comes from. Now, it doesn't always appreciate. We all know there's been times in history where the property value fluctuates, and the winners in those situations are the ones that didn't freak out and sell when the property values went down.
Yep.
Even through the last housing crisis that we had, people that kept their properties today are in the same or a better position than they were when they originally bought. So it's about being in it for the long run and holding on and not panicking and selling when the market goes down. Having a mortgage on your credit report does help your credit score. And also just meeting with a person like me, a mortgage advisor, I can a lot of times tell people the things they need to do to help build their credit score. Not paying someone else's mortgage. That's exactly what you're doing when you're paying rent, is you're paying for someone else's house. So why not start paying for your house, and a little bit of the payment you make every single month goes to the principal balance on your home, which helps pay it off. And then the predictable cost versus rent constantly changing is an important thing also to keep in mind, because leases are typically 12-month leases. So every year your landlord has the opportunity to look at market conditions and increase the amount of rent that they collect from you just by sending you a 30-day notice. That's all they've got to do.
It's a really nice thing having a mortgage, and it's consistent. Exactly, you know how much it's going to be every single month.
Right.
I mean, once you get your costs down as far as your utilities and your internet and your mortgage, it's on autopilot.
In the chance that interest rates do go down, you could always refinance and potentially even lower that mortgage payment.
Think of a mortgage more like, or when you buy a house, think of it as a savings account. Usually when any money that you invest into it, when you go around to sell the house, you're not only participating in the appreciation, but you're getting that money out usually when you're selling the house. So I like to tell people that sometimes when they're scared to put down a down payment where they could put that money towards another investment, think of your house as an investment. So personal finances, I'll let Alisha talk about this. This is her department.
So when you go to apply for a mortgage, when you go to apply for a house, when I work with borrowers, I talk about their personal finances and the things that impact your mortgage approval and your mortgage application. It's really important to keep track of what your debts are, and also the length of how much longer you're going to be paying those debts. Student loan debt comes into play, and it depends upon what the terms of repayment are for the student loans. It also depends on what the type of financing you get. the rules that we follow to determine someone's approval, whether it's conventional, FHA, VA, any of the different types of loans, are going to be different how we treat student loan. Car loans, we look at if it's a lease or a loan where you're purchasing the car. Credit cards, are you maxing out your credit cards, or are you keeping a lower, regular balance that you pay off on a
What's
regular
usually
basis?
a good, when you're pulling for a mortgage or credit, what's usually good under?
I recommend people to keep it under at least 50% of the limit. 30% is better. Paid off is better.
Yeah.
Paid off is best. What I tell most people is if they have credit cards that are maxed out, and some of them are $500 credit cards, and if you have a $500 Target card, one trip to Target and you've totally maxed that out.
Yep.
So if you have...
I've been there.
Right? So if you have credit cards, you want to try to keep the balance of the credit card at least 50% or below of the credit limit, or just pay them off at full and keep them at zero balances. That's really important. We also take a look at your annual income. So we look at how much you are bringing in each and every month and see, can you manage your debt and a house payment to have that all come into play? And then of course your down payment and credit score go into the factor as well, because the type of loan you get is going to be determined by how much you can bring to the table. The more money you bring to the table in down payment, the better financing terms you're going to get. And then of course your credit score determines the degree of risk you are in managing your existing debt. And so those are all things that are considered when you're going to buy a house. So it's important to talk to someone just as soon as possible. If you're thinking about buying a house, you want to talk to a professional just as soon as possible, because all of these things sometimes can be controlled or changed, and people can make an impact on these things, and what they think might be the best thing to do might not always be the best thing to do in the eye of the lender.
Exactly.
And so that's why meeting with someone, even if you want to buy a year from now, start the process of preparing for your application just as soon as possible.
That's critical. Question from the audience.
Yes, so if you are like an independent contractor and your income varies month to month, how does that affect your loan approval process?
That's a great question. So the question was, when you're an independent auditor or maybe self-employed, an independent contractor or maybe self-employed, how does that affect your loan approval? And what we look at is history of income. Because there are a lot of people, not even self-employed contractors, whose income varies. Sometimes people are on commission, sometimes people are hourly, sometimes they work nights, and so it's not the same each and every month, and it's understood. So what we do is we go back and we look at a history. So if you're self-employed, where self-employed people usually run into problems is they usually have really good tax preparers. So if you have a really good tax preparer that keeps your tax liabilities lower, then that reduces your ability to afford the mortgage, because we're going to qualify you on your taxable income that you declare to the IRS. So that is one thing. But usually we will take an average of your income over the last 12 months. We'll take an income average over the last 24 months to get an idea of, over time, what your income looks like and how much income is available to be able to pay a house payment consistently.
That's also another great thing that she was saying earlier about even meeting with someone a year in advance, because sometimes if you're thinking about buying a house in a year, you need to know how to file your taxes for this year.
Right.
I know when I was buying my house, I met with a lender to show for how much I should have made for that year, because like she was saying, when you file for your taxes, you can get that income pretty low, and that's what they're going to use. So if you made $10,000 at the end of the year doing your taxes, that's what they're going to look at. So something to really keep in mind when you're thinking about buying a house and you're self-employed, you want to project and think long-term or ahead and meet with someone as soon as possible.
And if that's the case, and you do have really low qualifying income on your tax returns, then sometimes there's options where might we bring in a co-buyer or a co-signer or somebody to go in on the investment with you that has more traditional paycheck stubs and W-2s and can help support the house payment. So it's not always a deal stopper if you've got a really great tax preparer, but it might just mean that there might be some other things that we need to bring to the transaction.
Critical thing, meet with someone as early as possible.
As early as possible, and we'll come up with a plan.
Alright, so this is just a quick little overview of what we're going to cover for the home buying process. So we got research, searching for homes, financing your home, making the offer, and the closing process. Alright, first and foremost, so all of you most likely know Zillow or Redfin or Trulia, and so when I meet with the buyer for the first time, we go through a wish list. This wish list is basically where you want to live, how many bedrooms and bathrooms, square footage, condo versus house. So we kind of go through that. And then also in this research process, we meet with a lender. This is the very first thing we start with, because it's like when you're going to go shop for a car and you don't know how much you're qualified for yet. So you might be looking at Ferraris, but you're only qualified for a Honda. So let's be real here. All right, so the searching process, after we've created that wish list, we've figured out kind of what you're looking for. So this is more of a collaborative effort between your agent and the buyer. So usually every buyer, I'll set them up on a custom search on a software that I use based off of the wish list that they've given me. So I'll be sending them properties on a daily or weekly, whatever you prefer. And then also, we're going out to open houses. You guys have all seen the open house signs everywhere. This is a collaborative effort. If you're out and about and I'm not available or your real estate agent isn't available, pop in, check it out. Properties do not last long in this market right now, so check it out. If you like it, let your realtor know, and they can write up an offer for you as soon as you let them know. And then obviously we go and look at homes in person. So, the process usually is you see something that I send you or you see it online, you immediately send it to me, I get started with scheduling a tour for you. So sometimes, properties are not available for 24 hours. Maybe there's a tenant, or maybe they have a baby and they can't jump out of bed and show the house in 15 minutes. Right. So giving your realtor a little bit of a heads up that you want to see this place is probably the best thing. And let them know as soon as you see something. Like I just said, this market is really hot. People are buying things, first, second, third day on the market. So let your realtor know as soon as possible that you want to see this place.
And Seth, I have a question. What do you see, when you do people are searching online by themselves, through the Redfin or the Trulia or the Zillow or those kinds of things? What do you find when buyers are out doing that kind of research on their own?
What I find is everyone loves Redfin. So, it's a great website. They have a lot of good tools that help you calculate an estimated mortgage. They are really good search parameters, so it's really good. I recommend Redfin. Also the software that I use is really good. It's called Real Scout. It's a really kind of modeled after Redfin, so there's a lot of similar features. Heads up about Zillow. A lot of people do use Zillow. Be careful, because Zillow is actually built for real estate agents and not built for the buyers. And what I mean is, agents are paying to be on Zillow, and Zillow is marketing those real estate agents. So what will happen is sometimes Zillow will market a property that's either been sold or pending or even rented already, and they're still showing you that it's active. So just be cautious when you're using Zillow, because it's not always as accurate or truthful as you may seem.
And that's one of the things I also like to tell people about the mortgage calculators. They're a handy tool, but really they're usually inaccurate. And they're inaccurate in the way that they give people a false idea of what their home is actually going to cost them in their ideal situation. It's a tool to get somebody to pick up the phone and make a call. So they can find out what the reality of buying a house is. So it's kind of like a bait. And so, it's always really important to get your specific terms and your specific loan information, and not necessarily trust the online calculators, because they leave out a lot.
Yeah, they do. Financing part, so we're going to go into that. Let Alisha kind of take that over.
Yeah, this is the fun part. Yay! Let's get all of our papers together and talk about that! Woo! So basically, the types of loans used to purchase a house, there's conventional loans and there's government loans. And basically, a lot of the difference has to do with ability of a buyer to be strong in their application. Conventional loans are typically privately funded, like Fannie Mae, Freddie Mac type loans. So what conventional is it's a loan program that's backed by Fannie Mae or Freddie Mac. Those are typically the conventional loan guidelines. And those loans are priced based upon a borrower's credit score and a borrower's down payment, and the guidelines that Fannie Mae and Freddie Mac put forward. With government loans, we're talking about FHA, VA, USDA, CalHFA, lots of acronyms, lots of really fun acronyms.
We'll get into those. We'll get into all those in a little bit. Yeah.
And the reason why the types of a loan are important is because it determines your mortgage insurance. If you are putting less than 20% down, how is that loan being backed? How is that loan being guaranteed and insured so it's able to be made? The interest rates and the payments are a lot of times based upon how your financing is structured and how it's set up. The documents needed for pre-approval are also determined by what type of financing you get. Some loans require different documentation than other loans. The general stuff is all the same, but there are certain documents needed. and then getting pre-approved. The pre-approval process can be really simple. There's actually a new tool called the Day One Certainty that once you fill out the online application, we can actually go in and verify your employment, verify your assets, verify your credit, and give you a pretty certain approval, the day you complete your loan application. It's really a neat tool. Where the magic happens is when you put all that information in and you don't get an approval, or you don't get an approval that you want. Yay, you're approved for $250,000. You can go buy in some other state than Southern California.
Yeah, exactly.
And so that's where we take a look at it and just see if we can dig a little deeper and find a little better way to finance your home to actually be able to get you into the house that you want to purchase. So the types of loans, I kind of went into them a little bit. The conventional loans, you can purchase with as little as 3% down. Generally, conventional loans are the loans which sellers prefer to work with because a lot of times they're the least restrictive on the property conditions, especially if you're looking at condos and townhomes. So conventional loans are certainly the most popular. The conventional investors are also the most restrictive. Like when they look at the debt to income ratio, they want it to be lower than what FHA or VA calls for.
That was a really critical thing that she just said. If you're looking to buy a condo, a conventional loan is probably the way to go.
Right.
The building actually has to be approved
Right.
for the second loan and the fourth loan, FHA and VA.
Right.
The building has to be approved. And they're very rare, so
Right.
something to think about if condos are your path.
Right. And with conventional loans, what we're looking at first and foremost is a credit score. Credit score is king. It can get done at lower credit scores. It just gets a lot more expensive at the lower credit score. So that's something to keep in track of. The FHA loan, the Federal Housing Administration, that's a loan backed by the Department of Housing and Urban Development. And they set the guidelines for the lenders, which allow the lenders to be more easy to work with as far as giving the approvals. FHA allows the debt to income ratio to go higher. FHA allows a little bit more flexibility in where the money for closing is coming from. The mortgage insurance is a little bit different, the cost of the financing is a little bit different, but more people get approved with FHA financing, which means they go find a property that's FHA.
Audience question.
Yes, Alisha, what is conforming or non-conforming? What does that mean?
So conforming or non-conforming deals with your loan amount, your loan limit. So conforming loan limits, there's loan limits set by the county. So every county in California has a different loan limit, and the guidelines and the pricing of your loan changes based upon where that loan limit's at and where you're applying for. So the conforming loan limit in San Diego County is in like the 450 range, and when you go over the 450, you're in a high balance limit. Then the high balance limit in San Diego County is like the 650 range, and once you go above the high balance limit, then you're into jumbo. And once you get into jumbo financing, the guidelines change. That's one of the things we go over when we initially meet, is what your goals are, what your objectives are for the type of loan you're looking to get.
Another thing to consider with the FHA loans is actually your credit score can be a little bit lower. So
Absolutely.
this is why it's FHA loans are usually the most attractive for first-time buyers. So it allows you to have a lower down payment, and usually your credit score can be a little bit lower. So this might be, if you're a first-time buyer, a little bit for down payment, your credit isn't amazing, this is probably the path that you might go down.
VA is the loan that's a benefit of our service members. So active duty and retired military can use VA loans, and it really is the best financing program available. So if you're looking at a condo or a townhome, it might be more difficult to find a property that actually qualifies for VA. But if you're looking for a single family home and you have this benefit, you want to use that benefit. It
Zero
really is.
down payment.
Zero down payment.
Zero.
Absolutely, absolutely. And no PMI.
And no PMI.
Yeah, VA
Mortgage
doesn't-
insurance.
Yeah, VA doesn't require mortgage insurance. There is a VA funding fee that they pay with their loan amount, but they don't pay a monthly PMI. So it keeps their payments a lot lower than the others.
Mortgage insurance, just real quick for you guys, is basically the insurance, you're paying the lender to assure that you are going to pay your mortgage. It's basically protecting the lender.
Right. Basically, if we have to, unfortunately, foreclose on the house, we're going to have a loss. That's just the way it is. And so when a lender has a loss, if we've made the loan in good faith, in accordance with all the guidelines we're supposed to meet, if we do the loan right, but then the borrower falls on hard times and has to let their house go, then the insurance guarantees us and protects us against that loss. So we'll continue to make the mortgage loans.
If the property is appreciated, or you've done some work, or now you have some equity, you can always refinance and get rid of that property mortgage or mortgage insurance. Actually, it's not always. It's not always.
I was gonna say not always,
But
if
it
you
is an
qualify
option.
for a
It is an
refinance,
option.
it certainly is an option. And a
It's an
lot of
option.
people right now who bought the house 2, 3, 4 years ago, we're talking to about refinancing because they do have the equity now.
Yes.
Because they've enjoyed the appreciation, they do have the equity. When you refinance, we take a look at all your information again. We take a look at your credit score, we take a look at your income, we take a look at your employment history. So the application process is just like you're trying to buy your own house. But if you're in a better position than when you tried to buy a house, chances are you qualify for a better mortgage.
Yeah.
And that's why you would refinance. First time home buyer programs. Woo! These are my favorite. These are my favorite. So CalHFA, hands down, is my favorite first time home buyer program. What CalHFA does is they lend down payment monies to first time home buyers who qualify. So they will give you up to 3 loans from CalHFA. They'll give you the first loan to buy the house, either conventional or FHA or VA. There's even a VA CalHFA option. Then they'll give you a second loan that funds the down payment. So they'll give you either a conventional first that requires 3% down or an FHA first that requires 3.5% down, and then they'll loan you 3.5% as a second loan for the down payment. So not only are they funding your down payment, but they're also helping you get into the house just a little bit more affordably by giving you a below market interest rate. If you do need to take advantage of the third loan that they offer, which is the ZIP loan covers closing costs. So you can get either 3% or 4% towards your closing costs from CalHFA in a third loan. But the downside of the third loan is it does come with a higher interest rate. So you lose that below market interest rate if you take advantage of the ZIP loan, but you also pay an interest rate that's a little bit higher than what the market rate is when you're using the ZIP loan. So whether or not you have your own closing costs that's one thing we talk about is this is if you use your money for the closing costs, this is if you use your CalHFA money for the closing costs.
With this particular loan product, what would be the cash needed to close?
If you took
Purchase.
advantage of all of the programs, typically to make an offer on a house, you need a 1% deposit of the sales price.
1%.
1%.
1%.
So let's say you're making a $400,000 offer. You need to have $4,000 in the bank ready to write a check for a deposit. Then you also need an appraisal and inspection money, which is generally about another $1,000. So let's say you need about $5,000 in the bank. Now, if you took advantage of all 3 CalHFA loans, including the ZIP, and you can take the ZIP all the way up to 4%, I've had many buyers actually get their 1% refunded at closing. Like literally you can get that money back. Now, the payment is a little bit higher, so you have to be able to absorb that payment, and you might want to look because that might not be what you want. Maybe you don't mind investing that money into the transaction so you can get a little bit of a lower payment, but it is an option. It absolutely is an option. The other thing with CalHFA is those assistance programs are loans. So when you're going into the house, you're actually borrowing more than you're paying for the house because you're getting a first, second, and a third. So you could essentially be financing 105%. So that takes a little bit longer to gain the appreciation because you started out a little bit underwater, but it gets you in. It gets you in, it gets you started, and it gets you on the right path. The GSFA Platinum does it a little bit different than CalHFA, another great first-time homebuyer program. With the GSFA Platinum, they give you a loan to purchase a house, either conventional or FHA, and the money that they give you, the assistance that they give you, is actually a grant. It's actually forgiven and you don't have to repay it. So hey, that's kind of cool that it's, you don't actually have to repay it. The difference is that the interest rate on GSFA Platinum is a lot higher than the interest rate on CalHFA. So it impacts your ability to qualify, it impacts your ability to pay, it impacts your maximum sales price. So most buyers, when I have look at the scenario side by side, they actually prefer to go with CalHFA, and they don't mind having those subordinate financing that they pay off in the future, but certainly GSFA is an option. And usually when you're looking at these programs, you'll hear about both. The Home Ready program is a program put out by Fannie Mae to help buyers get into their first house. You don't have to be a first-time home buyer to qualify for the home ready, so that's kind of cool. You just have to not own any other homes currently. It gives a little bit of a lower interest rate than traditional, conventional terms. It does have an income limit though, and it's a little restrictive. It's in the $70,000 to $80,000 range in San Diego County. If you don't qualify for that, then you want to look at the other options that maybe don't have that restrictive of a limit. Some areas in San Diego County, some redevelopment areas, they actually have made areas where there's no income limit. So the property that you look at, there's a website where you can go in and link to see if the areas you want to fall in, what the income limit is for those areas. That's something that we work through.
For myself. Just went through that.
Yep. The USDA program is also another government program that's really cool. It allows for 100% financing. The difference with USDA is it's only available in eligible rural areas. So we're talking way east, Ramona, Pine Valley, those kinds of things. And they go by the census, they go by the population of those more rural areas. But it does allow someone to get in with 100% financing, which is really nice. And then it doesn't allow for income producing properties. So like if you have an orange grove or something that produces income, that wouldn't really be the right program for you. And the MCC, the Mortgage Credit Certificate, is a really great federal program that really isn't a loan program, but it does assist buyers. And what the Mortgage Credit Certificate does is it changes how you're able to write off your mortgage interest on your tax returns. This program was actually supposed to be canceled with the tax plan, and it wasn't. So it wasn't canceled with the 2018 tax plan, but there are many agencies that are no longer funding it. So this might be the last year to be actually able to receive a mortgage credit certificate, and it's a benefit for first-time home buyers, and you have to apply for it with a lender that does MCCs when you're purchasing the house. So if you qualify and if it's available, then it's definitely something to look into when you're making the purchase.
Great. So recap really quick. It's kind of a misconception that you need 20% down or even 15% down. But what Alisha just said is that you pretty much only need about 1 to 2% of the purchase price to get into a property in San Diego. So blow that 20% number out of the water. If you have it, great, but a lot of people don't have 20% of the purchase price just lying around. So it's a lot cheaper to get into a property than people think. And there's a lot of government programs that are out there that can help you. So working with a lender who actually knows what those are is really, really beneficial, because a lot of lenders don't. So working with a lender who knows about these programs is really, really, really important.
So the documents needed for the pre-approval, all the paperwork that you need. So basically, we have to document your financial picture with your paperwork. This is always the really fun part. And like I said,
Yay, document.
Yay, documentation! Yay, let's go pull it out of the drawer and dust it off. And again, different loan programs require different, but this is just generally, we're going to look at your last 2 years of tax returns. What we're looking at is your federal tax returns, but we do need to see all the schedules and attachments and worksheets and statements that go along with your tax returns. So 2 years of your federal tax returns. I usually recommend people to just, the folder your tax preparer gave you, just bring it to me, and I'll copy out of it what I need. Because if you try to pull the pages out, you're not going to grab the right ones. So let me do that. I live for paperwork. W-2s, we look at the last 2 years of W-2s to really put together an employment history for you during the last 2 years. 30 days of paycheck stubs. Not only do we want to look at the history of your income, but we need to see where it's at right now. And in comparison to what your income was last year, are you still on the same track this year? Last 2 months of bank statements, all the pages. Even that page that's intentionally left blank. If it's page 3 of 5, we need it. So the bank statements, investment statements, retirement statements, 2 months worth is what we need for the full loan approval. Usually for the pre-approval, I only get 1 month, just because we get 1 month now and then we get the next month. But generally, that's the paperwork you want to have pulled together.
Woo! All right.
We found a house!
So that was good. Now let's talk about writing an offer. So we've gone through the wish list, we've looked at properties, we've gotten excited, and now we finally found the one you want to make an offer. Okay, so the first we're going to get into this a little bit more, but you need to think about a cover letter. This actually isn't the most common thing, but I require it with all of my clients. So a cover letter is basically kind of who you are, what you do, why you love this place so much, and why the seller sell the house to you. So that's a really important thing. It gives your offer not just who is buying it, but it gives the offer some personality. When you're dealing with offers, it's just numbers and you look at it, the seller has no idea who you are. And sometimes these people have lived in their houses for 20, 30, 40 years, and they want to know that the house is being passed on to someone who's going to love it as much as they loved it. And this cover letter really gives the opportunity for the buyer to do that. When we write an offer, we basically need to look at what's sold in the neighborhood. We look at pricing, we pull recently sold houses or comparables, and get an idea of what the neighborhood is supporting for value. So we need to get a real good understanding of what our offer is going to be. If it's listed at $400,000, but houses in the neighborhood have been only selling for $350,000, we need to kind of base our offer around that, because when it comes around to getting an appraisal done, the appraiser is going to look at what has just recently sold. And if nothing is sold in the price range that the property is listed for, it's not going to appraise. And we're going to have some problems there. With writing up an offer, there's some common contingencies. Contingencies meaning you're going to be looking at investigations or your inspections. There's a timeline for that. There's a loan contingency for how long the process of getting your loan approval. And then there's also the appraisal process or appraisal contingency. These are all contingencies that we can play with based off of who your lender is and your aggressiveness with how fast you can get the inspections done. And this really dictates how competitive your offer can be. So, for example, let's say a house has 4 offers on it, and everyone is kind of going by the common contingency periods.
Right.
But we come in and say, oh, we're going to only need 5 days for our inspections. We're only going to need 14 days for our loan approval, and we can remove all of our contingencies after 17 days. That's super attractive to a seller because they know quicker that their house is going to be sold. And there's no question marks about when it's going to happen or if it's going to happen. So the quicker we can get the seller the answers that they're looking for, your offer is much more attractive. So then once we've kind of figured out the price, we've written a cover letter, we've talked about the strategy for the contingencies, we go in the negotiations process. So we've submitted the offer, the agents have been priced with contingencies, with escrow period, and we go back and forth in this kind of game, this dance back and forth with counter offers, another counter offer, and eventually, if everything goes to plan, there's mutual acceptance. So that's when basically both parties agree on terms and price of the contract, of the offer. I'm going to get back into the cover letter. So when you're writing a cover letter, more is better. You can always take back. But you want to talk about the property, why you love it, what's so important for you about the property, why do you love it so much? Again, this is adding some personality to the letter, letting the sellers know a little bit about who you are. If you love dogs, if you love cooking, you have a husband or a wife or a spouse or parents that are going to be living with you, put it in there because it gives the offer some personality. And then tell them about who you're working with. If you're working with the #1 realtor in San Diego or a badass lender, you need to put that in there because that gives the other party, the seller and their agent, an idea of who they're going to be working with and how strong they are that they're going to be working with someone. And then throw a picture in. If you got a dog, if you got a baby, you got a spouse, throw in a picture. Again, we live in a very visual society nowadays. I mean, Instagram, you're going through that thing 100 miles an hour every day. So throw in a picture. Throw in 2 if you want. Give the offer some personality. So the closing process. So on day 1, this is when the clock really starts. The seller has now accepted your offer, and that's day 1. We start that and call it day 1. By day 2 or 3, you need to wire in or bring a check to the escrow company, which is the facility or the party that's handling all the finances, all the documents, and making sure that we have a complete package. But on day 2 or 3, you need to wire in that 1% that Alisha was talking about, the first initial deposit of the purchase price that you've agreed upon. Day 3, even before day 3, you're usually meeting with them on day 1, but you're meeting with your lender. You're letting them know that you now have an accepted offer, you're buying a house, you're going forward with it, you're doing it, and you're meeting with your lender. You need to get that started because the lender is then going to order your appraisal, which could take a couple days. All of this is just part of the process and you need to stay on top of it. So day 1 is probably when you're meeting with your lender. Day 4?
Before day one.
Before day 1, yeah.
Before day
Well,
one. Usually meet with the lender on day 3 is the second or third meeting,
Yeah.
and that's when we celebrate.
Yeah.
And that's when we sign everything and we go over like the actual applications and talk about the appraisal learning process and those kinds of things.
Day 4, it's usually day 4 or 5, we do the home inspection. So home inspections are critical. You need to have a great home inspection just to give you a thorough picture of what is going on in the house. This home inspection is going to talk about the roof, the plumbing, the electrical, the appliances, the foundation, everything that goes into a house. If you have a good home inspector, they're going to check this all out and they're going to give you a really good picture of what is going on with this house and what's wrong or what's not wrong with the house. So usually after we do the home inspection, there's always going to be something wrong with the house. So a lot of first-time buyers are scared because they find out, gosh, there's a leaky roof or there's electrical things that are messed up. Don't be scared, because this is where the fun can happen. We might have had a price that you didn't really want to agree upon, but you did it. This is where we can actually get the seller to give you a credit for whatever things that we find that are wrong. They could do a price reduction, they could do both. This is where we really negotiate and get the price down or get you a credit towards closing costs or something based off of what we find in the home inspection. So the more thorough your home inspector is, the better, because you can use that to your advantage when you're negotiating later down the line. But usually by day 17 or even earlier, this is when you remove your inspection contingencies. So this is now you're saying all of our inspections are done, we're moving forward with everything else, but this is when we actually remove our contingency, but all inspections are done. Day 18, usually by day 18, sometimes sooner, the loan is completely approved. You're ready. We can let the other side know that we have received full approval and we're going through with it. It's gonna happen. Usually by day 21 or a little bit earlier, we remove all loan contingencies, all your other contingencies, they're out of there. Day 28, you're signing your loan docs, you're signing usually before day 28, you're signing your escrow papers, you're signing your loan docs. It's a big day. You're signing probably 500 pages of stuff. So, and then on day 30, that's when you wire in the last funds. So if there's any remaining balance for the down payment, that's when you wire in the funds. That's also when your lender is gonna wire in the loan and close the deal. By day 31, it's happened. You bought a house. You get your keys. You get your keys usually that afternoon. So a lot of people think, they have to wait a couple days to get the keys. Nope. If we've had confirmation that we have recorded title and that the house is yours, the keys are yours that day usually. So if you're available. Yay! You bought a house. Super exciting. Super exciting. Buying a house is probably, to some people, one of the most important or biggest achievements that they've ever done in their entire life. I know when I bought my first place, I was ecstatic. It's huge. It's huge. So buying a house is commendable. It's amazing. It's a great financial investment for the future. So working with a team like Alisha and me is incredibly important, because you want to work with someone who knows the market, who knows what financial products are out there for you, and just has a good relationship with the community and other people that work in this community. I've had many clients get their offers accepted, not because their price was the highest, but because I knew the other side. I knew the agent and I knew the lender.
Right.
So something to consider. Working with someone who really knows the market, really understands the financial products that are offered to them is super important. I wanted to thank you all for watching this and being here.
Thank you.
Any last words from you?
No, just it's really exciting times. Feel free to reach out if you have any questions at all, and we'll look forward to approving your loan.
Looking forward to working with you.